and welcome to the second episode of the Bluegrass Broadcast. I'm your host, Kyle Gabhart, and we have a special guest with us today, the one, the only, Bluegrass's practice manager, Tosha.
Hello, everyone. Thank you so much for having me.
Really thrilled to have you. This episode's going to be a little bit different, partly because Tyler's not here, and partly because we're going to back it up and really get back to basics. It's so easy to overcomplicate finance, and so we're going to be talking about things that we're doing in portfolios that are more fundamental in nature. We're going to talk about shifts in the way that you approach finances, and we're going to ultimately get an understanding of some practical steps that you can take. Now, depending on where people are at in their financial journey, today's episode might be something that's just a good reminder or accountability. Maybe it's the kick in the pants you needed to do ultimately what's in your best interest, or it could be that there's someone important in your life that you want to share this message with, and we encourage you to share the episode as a result.
Absolutely. Well, we do have a lot to cover, so let's jump right in.
Perfect.
So, Kyle, the markets have been volatile. People are feeling uneasy. What are you thinking you should say to investors right now?
Oh my goodness. It's such an important place to start, because whether people are stressed about the closing of the Strait of Hormuz, or whether they're worried about, goodness, the gas prices that they're experiencing, or how expensive groceries are, or unemployment and robots are taking our jobs, with all of those things, it's easy to feel the stress and the pressure. And the thing that we want to remind people about is that while history doesn't exactly repeat itself, it does rhyme. So for sure, there are things going on right now that are unique. There are things going on right now that we haven't experienced before, but there's so many common trends. And so whether you look at how the economy behaved during the COVID lockdown, whether you look at the '08 crisis, whether you go all the way back to the '70s, where you've got stagflation as well as you've got oil shocks, we've seen things like this in the past, and we know how to maintain our right mindset and ultimately how to structure portfolios to be able to navigate it.
So, when you say back to basics, what does that really mean in a volatile market?
Sure. Most fundamentally, it means don't overcomplicate things. People tend to want to chase the trends. They'll see a video on TikTok and there's some compelling bar chart on there, and they want to chase some sophisticated strategy or some fancy approach, thinking that that's going to be the key that unlocks it. But it just doesn't work out that way. And we find that if we go back to basics, if we stick with tried and true principles, and if we design portfolios with consistent elements that are going to work in good markets and bad markets, it ultimately is the smarter strategy.
Well, speaking of those portfolios and specifically, so what would be those core principles that people should be focused on right now?
Well, the good news is we're going to handle it for them, so they don't have to worry about that. But we do want to kind of lift the hood a little bit and give you a sense of what's going on. There's been a heavy emphasis on the tech sector and artificial intelligence. There's been a lot of growth there, but we have intentionally, over the last year to year and a half, been backing off of our exposure to technology. We've been leaning into things like precious metals, energy, specifically oil and gas, food, rare earth minerals, all of these underlying elements, they get called alternatives, they get called commodities, and they operate in their own cycle, their own marketplace, separate from stocks, separate from bonds, because in the modern portfolio, it takes a different approach to properly build a way to navigate through things. So while the energy shocks that have come up have been frightening, because of our exposure to oil and gas, it's actually worked out really well for our clients.
Okay, well, good. So I know we talk about diversification a lot. So why does that matter?
Well, diversification gets thrown around a bunch, and it's oftentimes misunderstood. The first thing I would say is that diversification, as opposed to concentration, has a different purpose. So if you're looking to grow wealth, if you want to build it for the first time, use concentration. You could concentrate by writing a hit song. You could concentrate by inventing a company and building that up. You could concentrate by just being the best professional at what you do. You're a great example of that.
Thank you, thank you.
So concentration allows you to build wealth. But then when it's time to defend it, when it's time to protect what you've built, that's where diversification comes into play. And so diversification very simply is don't put all your eggs in one basket, right? It's about investing in different asset classes. It's about having elements that balance each other out and that serve as a ballast when there's an economic storm, as it were. And we did it originally. We did this diversification. We leaned more into alternatives and commodities out of a desire to reduce risk, out of a desire to settle the portfolios down. What we didn't anticipate, and has been a happy accident, is that by taking the smarter defensive move, it's worked out really well, because when there's an energy crisis like there is now, having that heavy allocation into oil and gas has actually served our clients really well.
Got it. That makes sense. So I know that you're also a big fan of dollar cost averaging. It's one of my
Yes.
favorite things that you've taught me so far. So I thought it might be also helpful for you to teach everyone.
I would love to do that. I'm going to
All
need
right.
your help with an example.
Here
though.
I am.
Okay, perfect. So first off, let's just cover what it even means.
Okay.
All right. So dollar cost averaging is where you take the same amount of money and on a consistent basis, it could be every month, it could be every week, every quarter, whatever it is, you invest that same amount of money day in, day out on whatever that schedule is, without regard for, is now the right time?
Got it.
Has the market gone up? Has the market gone down? Is the news cycle favorable? You just continue to invest reliably no matter what, and it averages out those dollars over time. You end up investing and purchasing fewer stocks when they're relatively expensive. You pick up more of them when it's relatively inexpensive, and that averages you out, and ultimately you win through that.
All right.
So I've got an example, and this is one that Papaw, my grandfather, would be proud of, my dad for that matter as well. Of course, the bluegrass in Bluegrass is because Dad was raised on a tobacco and dairy farm just outside of Lexington. So we're going to cover a dollar cost averaging example, and we've got $100 a month that you're going to be investing every single month, okay? So that $100, no matter what happens in the market, you're going to put the same 100 in every single time.
Got it.
And right now, cows are going for $25 each.
All right.
So you've got $100. Cows cost $25. How many cows do you purchase, Tasha?
4.
Very good. And the market is headed up.
Okay.
Cows are now worth $50 each.
All right.
You're still going to put that same $100 in. How many cows do you buy this time?
I'm going to get 2.
That's exactly right. So you've got 2 cows. So far, you're a pretty savvy investor.
Accurate.
Really impressed. Month 3 rolls around. You got your $100 ready. But I hate to break it to you. The stock market just crashed. And currently, cows cost $10 each. So it's a little disappointing with the 6 you already have. But if you stick to your guns, how many cows do you buy this time?
I'm going to get 10.
There you go. 10 cows. And finally, month number 4 rolls around, and we're right back to $25 a share, or a cow. How many cows are you getting now?
4.
That's right. Now, it may feel like nothing really happened, right? So they went up, it went down. People all the time say, oh, investing is gambling. You never know what's going to happen. There's anybody's guess as to what's going to occur. And so in our scenario, you have invested a total of $400. And the stock market has gone up and down and sideways, but currently still about $25 per cow. You have, over this period of time, accumulated quite the herd. Your portfolio of cattle is now 20.
All right.
20 times 25 equals 500. So your herd is worth $500. But over those 4 months, how much did you invest?
400.
That's exactly right. And so dollar cost averaging ultimately protected you, because what could have happened was that you were waiting until the right time, and then by the time it was the right time, you were nervous because you're like, oh gosh, it went down to 10, I don't want to invest now. And then you missed the opportunity and everything's right back to 25, and you never had the chance to accumulate those. That's what dollar cost averaging does for you.
So in volatile times, It kind of reminds me of people who want to pull back on their investments or press pause or just stop altogether and wait things out and see what happens. What would you say to people who have that kind of mindset?
Yeah, it's such a common pattern for folks. And I think it really does come back to the cows. If you are trying to time it, and so many people try to time the stock market, it's a fool's errand because you don't know what's going to happen next. And if you wait until it emotionally feels like the right time to invest, you're going to have already missed the opportunity. And so it's crucial to just have a disciplined approach and stick to that long-term strategy.
So, in other words, don't let your decisions your emotions make decisions on your
Definitely.
portfolio.
Absolutely
right?
not. Terrible idea.
Got it.
Yeah.
So, shifting from investments to more of like an everyday life, what
Sure.
are those foundational habits that we should think about when going back to basics?
There's some core ones to stick to. So one that comes to mind is saving for a rainy day, making sure that you've got enough of a nest egg set aside. Another would be just very simply living below your means. It's not exciting. It's not a lot of fun sometimes, but it's amazing that if you spend less than you earn, things work out better for you. Pay yourself first is one that we talk about a lot around the office, of course. So really prioritizing, setting aside for your future. And speaking of future, just keeping the focus on the long term is such an important foundational habit.
And how should people be thinking about their cash reserves?
Yeah, it's one of those things that often gets overlooked. Now, classically, people would say you should have 3 to 6 months of expenses set aside in a rainy day fund.
I've heard that.
And that's a good place to start, but especially right now, with as volatile as things are, as expensive as things are, we're recommending that investors double that, more like 6 to 12 months. And then to the extent that someone might be in an industry that's especially at risk of robots taking their jobs, it's going to be better off to maybe even have more, closer to 18 months for folks that are in that risk.
Got it. So going back to living below your means,
Yeah.
absolutely no fun. Someone who loves to shop, that's for sure. But why is it so critical?
Well, Tasha, it is really, really hard to steer a boat that's leaking, right? If it's taking on water, it's going to make it challenging to steer. Furthermore, it's just stressful, right? You've got that emotional pressure. And what happens is people either end up living off of credit cards or they lean on things like a quarterly bonus. They bank on the idea of getting some kind of a raise to be able to suddenly get back to even. And that's just not a game you want to play. So if you've got variable pay, it's important that you build your budget based off of the fixed income you know is going to happen rather than the variable that may or may not be showing up.
So for someone who's looking to strengthen their financial foundation, what would be a practical first step they could take?
Oh boy. Probably the most important one would just be to start tracking and having accountability. It is amazing when you get laser focused on dollars that are coming in, dollars that are going out, and knowing where all of those are. It doesn't seem like tracking would suddenly change it, but it does. It changes your decision making. When I went on my weight loss journey, I found that simply tracking everything that I took in made such an impact because I didn't realize how frequently I would swing through the kitchen, grab a cookie, chomp down.
Well, Tammy is a wonderful
She's
baker.
an incredible cook. So I definitely have the deck stacked against me. It is
Absolutely.
no fair. But I wasn't doing myself any favors, and I didn't realize how much all throughout the day I would be taking on calories until I started tracking it. And the same is true of the budget. So if you start tracking every dollar that comes in, track especially every dollar that goes out, then you start being more mindful of the financial decisions that you're making. And it ultimately then leads you to a situation where you can have more accountability and begin to really make progress.
Got it. So talking about some of those foundational habits a little bit more in depth again, explain pay yourself first.
Ooh, pay yourself first is such a shift in thinking. It really is about where your priorities are. So the absence of that, so pay yourself last is what people kind of default into. So that's you take your money in for the month And what you end up doing is you go, okay, I've got all of these expenses, all these things I need to do in my life, and I'm going to do all of those. And then at the end of the month, if there's anything left over, then I'll invest in my future. And shockingly, by the end of the month, there's little, if anything, left. So pay yourself first flips that around. And it says, no, 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 no. I'm going to prioritize my future. I'm going to prioritize taking care of myself and my needs and ultimately what's in my best interest. And so it starts off with saying, all right, I'm going to do the things that are crucial to my future. I'm going to tithe. I'm going to save. I'm going to invest. I'm going to reduce my debt. I'm going to do those things that set me up for success. And then on whatever's left over, that's what I live on. So it's really flipping those priorities on their head.
Got it. So it sounds like delayed gratification, right?
Absolutely.
Why is that such a powerful principle?
I think back to the Stanford experiment done in the 70s, the marshmallow experiment,
Yes.
right? And it's really, they would put a marshmallow in front of a kiddo and tell them, if you can wait, then you'll get a second marshmallow. And some kids couldn't wait. And they're like, but it looks delicious. And others would go, okay, I can take some temporary pain, temporary drawback for a long-term gain. And they then followed these kids afterwards and found that the ones that could embrace delayed gratification had a more successful life. And so this was something that my dad drilled into me for years. It was one of those principles that he brought back from the farm, that if you're willing to endure some temporary pain, if you're willing to do without now, then you set yourself up for more success in the future.
It sounds like the trouble I have when deciding if I should do 2-day shipping or overnight or my shopping for Amazon.
Yeah,
So, okay.
something like that.
Delayed
You got it.
gratification is
Delayed
good.
gratification, really important.
Got it. And so if someone feels the urge to make a pretty large purchase with everything going on right now,
Sure.
what advice would you give them?
So the first thing I would say is, if you've been planning it for a while, right? If this was something that was already in the cards and you've saved for it and it's not an impulse buy, go for it, right? Take the vacation, buy the boots, right? Whatever it might be, like, I'm good with it. But if, on the other hand, you hadn't been planning on it, in the current environment, this is not the time to be making a snap decision or an impulse purchase, anything that's significant financially. You really don't want to jump and do that reactively.
Right. So it's good to act fast when you're like getting bugs and snakes away from you, but maybe not so much with investments.
Absolutely right. And you know a thing or two about swatting away bugs
I
because
do.
you really enjoy the ladybugs in our office.
Oh, gosh. Well, that sounds bad. So I'm not afraid of ladybugs. That would be wild, right? One ladybug, adorable. 1,000 of them dive bombing at your head and your computer while you're working. It was a little distracting, yeah. It's a strange problem to have.
I don't remember it being quite 1,000.
Well, it was a lot.
Fair enough. It's the charm of having an old farmhouse.
Yes, I love it.
Well, now that we've kind of cracked into a little bit of your phobias, let's talk some more about you as a person. So we're going to flip the script a little bit.
Okay.
And you've agreed to let us take a little glimpse into the financial journey that you've been on.
Absolutely.
And if you would start off by just telling folks about how money was treated when you were a kiddo and the family you grew up in.
Sure. So growing up as a kid for me, money was scarce. I grew up with a single mom. She had 3 kids, was a school bus driver. So it was, not a whole lot of extra things. Some government assistance helped us out a few times here and there. We never went without, but we had just enough, I would say.
Understood. Now, what were some of your early experiences with debt as a part of all of this?
So I actually, different from my friends got credit cards when they turned 18. As soon as they came in the mail, they were opening and, buying concert tickets and all these fun things. And I was scared. I was like, that doesn't make sense to me. There's no money there.
Sure, right.
If it's a fake car, like it didn't track with me. And so I actually didn't get my first credit card till I was almost 30.
Okay.
So it's 27, 28, something like that. I thought I was doing the right thing, swiped it a couple times, fully planned on paying it off. Then, went to Target with my friends and went a little swipe happy, picked out every candle there was. And I did that for a little while. And so then I kind of learned, no one had taught me before, keeping your credit down to a certain percentage and that kind of thing. So once I looked into that, I started paying those off little by little and kind of got myself out of that little crunch.
Good for you.
Thank you.
But then COVID came along.
Oh, yeah. You mean, everything's fine. Nothing happened in COVID. No one had any problems.
Yeah. So how did you handle that experience with lockdown and unemployment and all those things going on?
Right. So in 2020, I was working at a place and we had to shut down like everyone else did.
Sure.
I was in a sales and marketing type position as well. And so, you can't really go out and talk to people and sales and market people when everything is shut down for the pandemic.
Yeah.
So that first year, I took a 40% pay cut in my salary. I was living off credit cards. I was paying bills with credit cards just to get myself by from month to month.
Sure.
Because I had raised my standard of living so high.
Yeah, no, that makes perfect sense. So throughout all of that, then what was the turning point for you?
Honestly, the turning point was starting here at Bluegrass.
love that.
Just listening to in on client meetings and the teachings and things like that. I was taking notes for myself and just started putting little I would say habits in place to where I'm definitely paying lower than or higher than the lower payment
Sure.
on that debt. And things like that. I started investing in my 401k more and raised that. So it was just really helpful.
That's excellent. And so then, as you've come across to the other side of that, gotten debt under control, and you've nearly got your debt paid
close.
off. Congratulations!
Thank you.
Super exciting.
Thank you so much.
What does your discipline daily habits look like now?
All right. So paying yourself first. We use it. I practice what we're preaching. So tithing is something that is really important to me, and there might not be a mathematical explanation to that. It's definitely something I do for my faith, but I will tell you, I have just had more money appear in my account since then. But I have been, making sure that the minimum payment plus a substantial amount in that debt is taken care of first, and of course investing in that retirement fund, not just the minimum amount. That 3% is so gracious that is matched. That's free money on the table. Of course I'm going to take it. I know it's not free money for you, so I won't say that, but free money for me, so thank you. But no, just increasing that even to go a little bit more at 5%.
Yeah, it's good.
So just a few of those really make a difference once they start stacking up.
That's huge. So the thing that is so exciting is not just seeing the progress you've made, which has been huge, but I've noticed a change in the way that you think about and talk about money. So share a little bit about how your mindset has changed.
Wow, it's been a whole 180, I will say for sure. When I was young, again, money was scarce. So I thought that you had to have been born rich, you had to be famous to get rich. Or you just, got lucky and won the lottery or something like that. So it was kind of this make-believe, never going to happen type situation. And honestly, again, since working here and seeing our clients and how they have built their wealth, now I'm like, oh, there's money out there. I just have to figure out how to make it mine.
So good.
Get it in my account and start a legacy so that my children don't have to answer that question the same way I did. They can talk a little bit how they got started by something their mom changed.
I love that. I love the legacy aspect, obviously, but I love the breaking the cycle, right? Breaking that pattern and starting a new pattern and a new cycle and a healthy one. That optimism is infectious.
Well, thank you.
Well, I really want to thank you so much for being vulnerable and letting us get a glimpse into what's going on in your world and the journey that you've been on. And hopefully that resonates and relates for folks.
Yeah. Well, thank you. I was happy to share.
Yeah, you betcha.
All right, so we have a few minutes left. I think one of the ways we could use this time, because we did cover a lot.
We did.
Why don't we go ahead and go over the main takeaways that people should take from today?
No, I'm glad. It is important to kind of recap all of that. The first thing, number one, is just know that no matter what happens on the news, no matter what the media is talking about, we have prepared clients with portfolios that are well balanced. Portfolios that are not just leaning into one industry or one sector, but that are designed, because of diversification, to be able to weather the storm. And a great example is the energy spikes and how well positioned we've been for that. But there could be something else wacky happen this summer. There could be something come up next quarter. And rest assured that, first of all, we've built the portfolios to prepare for it. But secondly, they are nimble and we jump in and adapt as needed. Then as we pivot into thinking about personal finances, there's some foundational things that are going to help people no matter what, right? And that is making sure that you've saved enough for the future, making sure that you're living below your means, and don't get caught in the situation you were in years ago where you were leaning on that variable pay that then suddenly wasn't there.
Right.
And paying yourself first, so important. And then ultimately having that more long-term vision. And then the third thing that we talked about finally was really about the behavioral habits, how crucial it is to track and have accountability. And finally, I would just ask, if there was someone out there that's heard all of this and is wondering, but maybe it's too late for me, maybe I've missed out, I would have been good if I'd done all of this a few years ago, but there's just no chance now, it's too late. What would you say to them?
It's absolutely not too late. Listen to these back to basics and these fundamentals. It's as easy as starting with tracking. Just start tracking. You will start to see things you can make changes on there, paying yourself first, just those basic back to basics, what we covered today.
For sure.
But also don't get disheartened, right? So if you swipe that credit card when you shouldn't, give yourself a little grace. It's not always a straight line dance. Sometimes it's the cha-cha, which is fine. But just keep focused, and if you feel discouraged or you need help, reach out to a financial advisor. We would be happy to help, obviously, but definitely look for someone who can help give you that guidance.
That's so good. I have really enjoyed this episode. Thanks for joining us.
Of
It's a
course.
shame that you won't be joining us next
I
episode,
know.
But we'll have Tyler back. And what do we got going on this summer?
So this summer is really exciting. We have a client appreciation event coming up in July. So if you're a local to DFW client, check out the newsletter. It's our Bluegrass Bulletin. It just went out last week, and it has a link there to RSVP. There'll be video games, bowling. We're beating the heat. We're not going to be outside like we were last year. We've got some AC situation going on. Make sure that you RSVP because we would love to see you there.
I'm excited about it.
Me too.
All right. Thanks so much, everybody. See you next time.
Bye.
Bye.